Hello and welcome back to Jukascopy TV. Today we're looking at how well Russia's economy really is doing and what challenges Russia is facing. Joining me on the line to discuss is Uday Tharar from Goldfish Capital. So Uday, inflation in Russia seems to have peaked, and the US dollar against the Russian ruble currently stands at 62.04. GDP data out today shows Russia's economy shrunk 3.8% year on year. So where do you expect the currency pair to move from here?
So fundamentally, there is nothing much wrong in Russia now from a currency point of view. The steep fall in FX reserves we saw over the last year or so has now stabilized. Russia still has a large current account surplus, and its trade balance should not worsen significantly from here if oil prices stay at current levels or probably could rise. And according to CBR, the net private capital flow surprisingly turned positive in the third quarter this year with inflows of USD 5.3 billion following 19 consecutive quarters of capital outflow, and compared to an $18 billion outflow we saw in the second quarter. So as a result, Russia's balance of payments went into a surplus in the third quarter for the first time since 2012. Also, the 5-year sovereign CDS spreads have fallen from as high as 650 bips in January to 325 bips now. On a real effective exchange rate basis, Russia's currency looks undervalued by over 10%. I see the ruble appreciating against the dollar in the coming.
Russia's economy is heavily dependent on oil. The World Bank has said the drop in prices could lead to Russia's economy contracting by 0.7% or more this year. So how would you describe Russia's economy at present?
Yeah, that's right. So based on our calculations, $10 per barrel fall in oil prices lowers Russia's annual GDP by about 0.8%. This implies that the roughly $50 barrel drop in oil prices since the third quarter of 2014 explains about 4% of the GDP contraction. Russia's 2015 economic slump turned out to be deeper than we expected, mainly due to unfavorable external climate and also because of the drop in oil prices. GDP contracted by 4.5% in quarter two and by 3.8% in quarter three, mainly because of the decline in domestic demand and investments as well. Household demand has been stalled, mainly due to the fall in real wages, which have fallen by over 10% now. Yet record high corporate profits due to ruble devaluation are not yet translating into capital investments. Continued high inflation, relative low indexation of nominal wages, and households' growing incentive to save will not be conducive to restoring a positive dynamic in the consumer demand in the next few quarters. Saving rates has actually shot up by 3 to 4 points in the last year. Production continued to contract in September, but the decline has moderated to 3.7% from 4.3% in August. This is marginally positive as the third quarter industrial production numbers rebounded to minus 4.2% from minus 4.9% in quarter two.
Russia's intervention in the Syrian civil war leaves a question mark on how it can impact the condition of the country's economy. So with this in mind, could Russia's intervention have an effect on the already vulnerable inflation figures, and how significant could this impact be?
So inflation in Russia has been mainly influenced because of the exchange rate. The ruble's weakness generated a significant inflation pass-through effect, especially in the period of November 14 to February 15. These readings will fall out on the CPI base and also because of the ruble now stabilizing. And I see the headline inflation returning to digits early next year from as high as 15.7% currently. The central bank, I feel, will keep cutting rates this year, but I do not see any upside risk to inflation because of lower rates as the domestic demand still remains pretty weak.
Well, Uday, thank you for speaking with us today. And that's all for today, but click back throughout the week for exclusive interviews and updates. Goodbye for now.